All right, we are live. Got to turn off the phone here so we don't get interrupted. How you doing, friends? Ernie here, and it is Monday, the start of a new week, and we love Mondays. I know I always say that. We love Mondays. One of the few people that probably loves a Monday, because Monday means the start of another zero DTE. I'm sorry. No, not a zero DTE, a zero dash DTE trading week. And, so far, the trade that we have on is kind of a nothing burger. And it wasn't one of the full implementations of our strategy. When we don't have a full implementation of our strategy, in other words, we don't exercise all 4 steps of the process, which include analyzing a catalyst so that we can determine market direction, then market structure through volume profile, then modeling an asymmetric trade around those first 2 steps, and then managing our profits. When we are missing out on the first part, then we have to do some mental gymnastics and come up with something that is probable and without the benefit of a catalyst. Now, that would mean that, perhaps we are doing just a technical trade. And I don't want to confuse that with technical analysis, but based on our market structure analysis and where price is and whether or not it is trending or not or consolidating, where's price likely to go? And what happened was overnight and starting from Friday, we had been in a pretty good trending move off of the bottom where we took what I call a buy the dip trade. And that trade is still on and still successful. And we trended up for about 4 or 5 days. Over the weekend, starting last night, it looked like we were going to continue that trade. And Sunday night, when the futures opened, market started to move up. That trade became much more valuable than it was the previous days. And so the expectation was that the following day we would continue this trend. So we'd go to sleep, wake up the next day, and lo and behold, after the European market opened, and for no particular reason that I could tell, maybe a little bit of strife in the world, concern over China and the Evergrande project, or COVID, or budgetary concerns, whether or not we're going to fund the government and have a shutdown or not, which is, it's a normal seasonal type of thing. Maybe all that combined caused the market to pull back a little bit. Not a lot, maybe 0.5% or so. But it appears to have stalled that trend that continued. And so here we are in the morning with I would say, really no significant economic reports coming out, none that would really upset the market or charge it or anything like that. And Fed governors were out in force, giving their daily speeches and hopefully bolstering their narrative. But really just a basic Monday. There's a 5-year auction today. That did not come into any prominence. So what do you do in the morning on a trade like that? Well, we look and fall back on the structural analysis of the market and see where we are in terms of where we were coming from. Because in the absence of any kind of catalyst, then I typically go with the trend. And the trend was up, but it had pulled back. So now we're in a pullback situation, and we're pulling back right to a volume node. And on that volume node, there's really good support. So the natural inclination there is, pullbacks are one of the few technical trades that you can take that have very high probability. And in the context of volume profile, coming back to and landing in a node, being above that node in a breakout mode, and then coming back into that node is usually also a good pattern indicative of further move up. So it's basically a trend pullback going back up. And so on that basis, we come up with a trade. Now this, again, is not the full implementation. We don't have the full confidence of this, so we call this a suggested trade. And so in the suggested trade, we decided that, okay, we'll pick a point that's above, maybe to the next volume node. We name our volume nodes with a T for target. And then I will number them T0, T1, T2, Tn. And that numbering scheme really is the order or the likelihood that price will move to that next target. So in this case, we were at T0 going to T1. And so we get out of T0, and then the European market opens in the morning, and we find when we wake up that market has pulled back, and now we're back in T0. And so this is a very, very common pattern where you move up through one volume node, what's called maybe the parent node to a child node, pull back to the parent node, and then continue back up, which is, again, like a pullback in a trend. Very normal price action. So it pulled back, but then it started to go up and then just decided to, hey, I think we're really happy right here, so we're going to hang out in this volume node for a bit, and it's been there all day. And we're on a second attempt to try to break out. Will it happen? I don't know. So the interesting thing on this particular trade, and what this episode is about, is how we go about managing profits in a zero DTE strategy, in the zero dash DTE strategy. And what are we looking for? So what I had declared earlier in the day when coming up with the trade, the suggested trade, because it's not an alerted trade, because it's not all 4 steps. That's the difference between suggestions and alerts, although we take all the trades. But I want to differentiate them that way so that people understand the difference. We have higher confidence in the alerted trades because when you have a catalyst or at least some evidence and something objective that is moving the market, then I think you can feel more comfortable in planning out where that trade might go and that there is some energy injected into the market. In this case, there wasn't any of that, and so here we are. It started to move up. Now, what I had told the group earlier in the morning was that this is one of those suggested trades. Don't know if it's going to go. It could not. I think that if we reached 50 or 100% return on our capital, then it's probably a good time to take that trade. And in fact, the initial move up, we easily achieved that 100%. As a matter of fact, I think it went over a little bit, maybe 150%. And so there was an opportunity to at least take some of the trade off. And one of our strategies that we use, if you're not trading with a minimal size account, because if you have a minimal size account, you couldn't employ this strategy. But let's say that you had a larger account and you could put on multiple positions, not just one position. One of the strategies is that once we reach or attain a certain percentage level return, then we take off some majority of those positions to guarantee a profit. So guaranteed profit. And then we let the rest ride in what we call a free ride. And on that free ride, should we move up further, then we gain further and possibly move up all the way to a pin trade and gain a lot. And if we pull back, no big deal. Worst that's going to happen is that we'll still profit, just not as much as we had hoped. So that's one of our profiting strategies. This idea of grabbing the initial thrust in the position and then allowing the rest of the position to move on. And so this would imply that we have a certain number of tranches that we put on in any trade, and how you actually get into those, that's another different type of strategy that we have. So when we enter a trade, often we will enter with a little bit of guarded nature. So this morning's trade, as it pulled back to support on the volume node, you get in with one position. If it pulls back a little bit more and you get a chance to improve your position or come up with a better cost basis, then maybe you add the second or the third tranche. And then once you start moving up and you're still in a position where you have good risk to reward, you have some confidence that price is going to continue move up only because of its the nature of the move. It's now accelerating, moving up. Maybe you add a second and third tranche, assuming that you have, say, 5 tranches for a fully loaded position. If you're still unsure, there's no reason then to put on that third or fourth or fifth tranche. You might just hold off and say, hey, 1 or 2 is good enough for me. And that might be the case where if you don't have the high level of confidence that you have in this trade versus other trades. And there are other things that might factor into that. So, for instance, if you have a tighter risk to reward, and what I mean by a tighter risk to reward is anything that is approaching 1 to 4 or 1 to 5. 1 to 5 is about our cutoff, where we say, look, if it's below 1 to 5, 1 part risk to 5 parts reward, not to be confused with what everybody else is doing, like 5 parts risk to 1 part reward or 10 parts risk to 1 part reward. We don't do that. But in the complete opposite, in a complete opposite situation, if we can't put on a position, and we look at each new position as sort of starting the trade over, put on that position in at least a 1 to 5 risk to reward potential for that trade, then we won't put it on. And so that's how we naturally curtail our position sizing. We had a question earlier in the group, are you position sizing based on volatility? The answer is a qualified no. And what that means is that volatility is constantly changing, and it's changing the nature of our strategy. And the strategy itself is kind of tuned into volatility in that by looking for certain types of criteria, like this 1 to 5 risk to reward, and also looking at the width and spacing of the volume nodes and the catalyst that has been supplied, the amount of energy that has been supplied into the market. Can price move? What is the expected move for that day is another question. Can price move 30, 50, or 100 points in that day? Is the potential there? If the potential doesn't seem to be there, then you can't put a trade far enough away and wide enough to give you that 1 to 5. So volatility and expected move have a natural tendency to adjust the amount of money that we actually put into trades. So in other words, when volatility is low and an expected move is low, that typically decreases the signal to noise ratio so that noise now starts obfuscating signal, making it more difficult to put on a trade that is clean. And so we end up putting on fewer positions in smaller trades, thereby using less capital. So I guess you can say then that the strategy is self-regulating in that respect. So again, getting back to how we actually profit on things like this, that is our primary focus too, is how we profit. It's a very high quality problem that we have in this strategy. We are not looking to manage our risk. In fact, there are times when, like today, we moved up sharply in the beginning and then moved back. Then you might think, well, you move back, and if you still have some positions left, are you going to take those positions off? I would say that it depends on how far we move back and where we move back from. If we came back to support, and it appears as if there's still some life left in this market, and there's enough time left, just let it go. Let the position go. It could recover. Now, I've found that when you have that initial surge and then come back, it doesn't recover that often. However, if you have an initial surge and it only comes back a small amount, like a small pullback in a smaller trend, everything's fractal in nature, then you might stay with the position. If you start off the day and never really achieve that first initial position, but maybe pull back a little bit, but never move beyond support, in other words, support is elevating you, keeping you there, and that's typically the edge of a volume node, or even in a volume well, you might come out of the node and then get rejected. Those are times where there is really, even though you may have 50 to 70 or even 100% loss in terms of the risk that you are willing to take on, because our risk is so small, right now there's no real reason to get out of the trade. You already have an unrealized loss. What are you going to achieve by taking that position off right now? Save a couple bucks? It doesn't make any sense. So the odds now are still with a better outcome. So we'll keep the position on. Now, if we move into profitability, now it's just a matter of, well, how much time is left in the day, and how much time do we think that we have, and how deep can we get inside of the profit area that is defined by what we call the T0 line in the butterfly? And is there a possibility of achieving or reaching the center part of that butterfly where the two short strikes are for maximum profitability? And then how long can we stay there? What does the market look like? What has been the pattern that you've seen happen over the past days or weeks? Is there still a high level of volatility? If there's a high level of volatility, sometimes you want to make sure that when you get near those two center strikes in the butterfly, you're not going to hang out there too long. You can't expect it because volatility is still high. It may go there, it may pass through and go to the other side of the butterfly. If it goes to the other side of the butterfly, now you start losing a little bit of the profit that you gained, depending on where you are in terms of the time of the day. One great thing about being in this trade is that once we're under the profit tent, time is on our side. Time is on our side because the decay is a continual thing. Time is the constant here. Volatility is the variable. But time is the constant. Decay continues to happen. So if we're volatile, but we're staying within a range, and we typically put our butterflies in a way that they kind of encapsulate a volume node. And volume nodes, if you've done the study with volume profile, you'll know act as a magnet or an attractor to price. So price tends to gravitate towards a volume node, and in particular the point of control or the highest level of volume within that node. And then it's planetary physics. You get a small object that moves near a planet, and as it gets closer, it gets attracted to it and then wants to orbit around it. It's very, very similar to that here. Those are the judgment calls that we make when price changes or when we have certain amount of volatility, we have certain time left. And all of this, there's no systematic approach to it. Unlike other failing zero DTE strategies where they have this systematic approach, but it's all designed around risk management because they're afraid of losing. And so they want to prevent losing. So as soon as they achieve some minimal level of profit, they get all excited and they want to get out of that as quickly as possible. And their minimal level of profit is something that would be their maximum level of profit. So for instance, in a iron condor situation, another zero DTE trade, once they achieve 50% of the available premium, which that in of itself only amounts to about 5% of our available premium in our trades, they will consider getting out of the trade for fear of pulling back and then going to one of the stops or one of the wings and achieving a max loss, which could be 10 times or 20 times the amount of profit that they've gained. So that's why risk mitigation on their side is such a necessary thing, because if they are not there trying to manage their losses, they would lose huge all the time. They end up losing anyways in the long run because it's a failing strategy. In our case, we're never presented with that kind of problem. We're on the exact opposite side, and that's really the point of this episode, is that ours, again, I'll repeat, is a high-quality problem that we manage the profits. Once we get into the profit zone, how are we going to get or maintain or realize at least a minimal amount of profit and go for more? So that is a fundamental difference in the way we trade versus other zero DTE strategies. Now, today is one of those days that there really isn't any reason to do anything but wait. I mean, we're consolidating inside of a node. The way things go in this market, we could as the market closes or comes near a close, we're almost near 3 o'clock right now, so we only have about an hour and 5 minutes left in the market. A lot of things happen. Volatility tends to pick up in that last hour. So we could pull all the way back to a deadpan loser, or we could start surging and potentially get up to where our target originally was and profit very nicely. That we don't know. What we do know is that there is really nothing to do but wait and see what happens. There is no real reason to get out of a trade here, because you're already at an unrealized loss, even though it's a minimal loss. We're not sweating over it because our losses are just a fraction of our potential profits, so it's not a big deal. And we're already coming off of, say, 5 or 6 consecutive wins and some very big wins. So this is not really, an angst moment, or there's zero anxiety. We're simply waiting. We'll wait and we'll see what the market brings us. And if it starts moving up, we'll just give it its room. If volatility starts kicking in a little bit, that'd be great too. And perhaps we can get to a pin trade, which would be phenomenal. And this has happened many times in the past. Now, I'll say that the current situation that we're in has a lower probability of success based on my experience. And that experience is that when you have an initial move that is in profitability, and we had that, and many of our members already took profit. So in other words, for many of the traders that are in the service right now, we've already got a guaranteed profit for the day. They're either out with 100, 150% profit, or they've taken enough positions off where they have a guaranteed profit so that even if what's remaining goes to max loss, they still have made a profit. That's my personal position too. And there are some that have smaller accounts where they don't have that luxury of taking a portion of their position off, because maybe they only have 1 butterfly on instead of 5, 3 or 5 or whatever the number is. And so they've decided just to hang in there. And that's probably the position of a third of the people that are within the service. And so what I would say in that case, there doesn't really make a lot of sense to get out of the position, because really the only outcome that you could have from here, different from where you are right now, is positive, right? If it doesn't move at all, then your position isn't any different. But if it moves up, then you could potentially move into profit. So it doesn't make a lot of sense to manage your risk, particularly when the risk is so small. So that, hopefully I gave you a feel for what it's like to trade the zero DTE way of trading, where we have an inversion of risk, where we're constantly striving to get better at managing our profits and negating the risk, compared to others that are hoping to get at least a sliver of profit and then spend most of their time managing risk. That's what we don't do that. They do that. So that's where we're at right now. Now, as I said, we don't take a systematic approach. It is completely a discretionary approach. We come up with, and the reason for that is that the market is always changing. The structural landscape, the market structure, is different in many different cases, and each trade is a little bit different. The volatility is on a spectrum. It's always going up or down. Things happen out in the market that can influence it all the time. I don't know how you come up with one set of rules that handles all of this variability. So what we try to do is we try to paint scenarios and understand what are the possible things that we could do. What happens if market does this, does A, does B, does C? And then manage each of those independently. So that's where we're at right now. Again, now we're sitting at almost at 3 o'clock. I would suspect that at 3 o'clock they call that, why do they call it the power hour? I hate that term. It might sound, make your trading sound exciting. All it really is that people start getting more engaged near the end of the market. They want to try to make their profit. They want to try to exit their positions. Volatility starts going up a bit. Volume goes up a bit. And so there's the potential that something could happen. So if you want to call it power hour, great. Do that. Whatever makes you happy. But we'll just sit here and we'll wait and see what happens. Take the old wait and see attitude. We have a question. Can I pay monthly and how much? Yes, there is a monthly payment option and a yearly payment option. So first of all, there is a 4-week trial to the service, and that's a paid 4 weeks. So each week you pay a small amount of money, and then 4 weeks should be enough time for you to get a really good feel for what the service is about. And what it's about is an educational service where you learn a strategy, methodology, and a process on how to become an options trader, an effective options trader with a strategy that has definitive edge. At the end of that 4 weeks, if you decide to go and take either the monthly plan or the yearly plan, I will rebate the cost of that trial towards the cost of the monthly or the yearly plan. The monthly plan has a upfront fee plus a monthly fee. The upfront fee is $285, and the monthly is $64 a month. And so if you join, then you would take the cost of the trial off of that upfront fee. That upfront fee covers the cost of support and coaching and mentoring, which is world-class by any objective standard. The yearly fee, if you pay a whole year up front in one lump sum, is about a 25% discount from the monthly fee, plus the reduction of the 4-week trial. So it's a really good. I would just say, look, just start off with the trial. Don't jump into the monthly or the yearly. Try it out. And if you like it, the worst that you're going to be out is a few bucks and an education on a fantastic strategy, and also a process. It's not just the strategy here. It's the strategy, the methodologies that we put into place, and the processes that we put into place. And all of that deserves really to be considered a first-class education in trading, and for really a fantastic price. All right. It is now 3 o'clock, and I see things starting to move a little bit. Probably not in the direction I want them to move, but that's okay. It could turn around at any point. And I want to thank everybody for showing up here. Thank you very much. And we'll see you on Wednesday. We'll let you know how things turned out here. As I said, for most of the members, it's already turned out to be a positive trade, a winning trade, where we made essentially what is our average, about 150% on an average trade. Some trades we will make as much as 500, 800, even 1,500%. But that I don't think that's going to be today unless the market completely surprises me. I don't know, unless Fed governor comes out and makes a surprise announcement on interest rates, or who knows? Who knows what could happen? But all's good. We're just going to focus on our high-quality problems of managing our profit, not our risk. I hope you enjoyed this episode, and we shall see you next time. Again, if you want to join the trial, it's 0-dte.com/try. Link is down below. All right, everybody, have a great rest of the day. All right. Thank you for telling me that. Where is off button? There you go.